Stephen Koukoulas, welcome back, mate.
G'day, Mark. Great to be back, and what a month we've just had, and what a month ahead of us.
There's just data's flying around all over the joint, not just locally, but domestically, I should say, but globally.
Yep.
If everyone's been terrified of a recession, and of course the US GDP numbers came out, and it looks pretty good. It doesn't look like they're going to go into negative GDP anyway, or negative growth. So, what do you make of it so far, mate?
Yeah, well, despite the rate hikes from the Fed, and they've hiked more than us.
Yeah.
We saw the June quarter, the second quarter GDP figures coming in at 2.4% annualized rate of economic growth. That's plus 2.4.
Yeah.
And for the US economy, that's a long way from a recession. So despite the rate hikes, consumers are still spending. Businesses are still investing. So a lot of that, what do we call it, the IT spending, artificial intelligence, all that sort of stuff is really driving the economy. So the big corporations, the massive five tech companies are still investing. That's GDP. They're still hiring. US unemployment's like ours in Australia, around about 3.5%. So in a funny way, it's a bit like the Goldilocks economy. Not too hot, not too cold, just right. And the inflation rate's coming down as well. So, I think the US might just get through this period of really aggressive rate hikes, growing at a slower pace, but no recession. Unemployment probably ticking up, but not too much.
So that's important. Just go back a step. If inflation is coming down, it's quite a lot down relative to Australia. Inflation in the US is only 3.5 or something like that.
Down to 3. It's gone from 9% in the middle of last year down to 3.
Right, 3.
Big fall.
What's interesting about that, Steve, is that and one of my theses about all the inflation's been imported, and it's all supply chain style inflation. Because what's interesting about that is I think it's fair enough to say, and I'd be interested to hear what you've got to say about this, that the interest rate increase regime in the US, which has been far more aggressive and started far earlier than we did in Australia, and is much higher, didn't have a big impact on people in terms of spending, etc., because they have a fixed rate environment there.
I was waiting for you to say that.
Yeah.
Correct. We know that the bulk of mortgages in the US are 30-year fixed. So these rate hikes from the Fed doesn't worry me. I took out my loan 5 years ago and I've got 25 years to go if I'm a US citizen.
Yep.
And so I've locked in my rate.
So I'm still paying the same rate today.
Correct, as I was 5 years ago when I took out my loan.
Correct. So your interest rate rise have done nothing to me.
Correct. What they've impacted is the business sector. They impact on the US dollar too, because as the US dollar goes up, and with the Aussie dollar's gone down, as the US dollar goes up, it's actually a constraint on their economy. It actually dampens their export sector, which is one way to slow the economy down. Having said all that, the impact of rate hikes also shows up in what we might call, for investors, an asset allocation decision. The US 10-year government bond, sort of linked to their monetary policy interest rate, is now 4%. So if I'm an investor sitting there, well, I invest in stocks or bonds getting 4% pretty much risk-free. So as interest rates go up, I'll take my money out of the stock market falls, you get a wealth effect, and as people feel less wealthy, that's how it can show up on consumers, because the US, I think, is the highest per capita ownership of stocks in the world. So if the value of your portfolio drops by 10, 15%, you might think, oh, damn it, I'm not going to spend as much. So that's the other transmission mechanism in the US, whereas in Australia, you're quite right. We've got 85% of mortgages are floating, variable. So when the RBA here tweaks them up, you pay it. And that's how it works. So we get a really more dramatic and quicker impact, which is why the RBA, one reason why they haven't hiked as much as the US. They don't need to.
They didn't need to. So
yes,
the US is still looking like they're going to continue to grow at a reasonable clip.
Yep,
2.5%. Reasonable.
Yep.
Or better still, they're not going to go in a recession. Looks like it at the moment. That's a good story. 2, they may not put interest rates up again. Well, they may not need to put interest rates up again, given where inflation is looking as it's heading in the right direction. But also, we're not going to import their inflation into Australia anymore, because if they've got their inflation under control,
correct,
we're not importing their inflation into our country.
Correct. The other big issue too is, and we don't look at it as much as we should, although some of us do, China. China is actually slowing down.
Yeah.
It was locked down for a long time for COVID. It reopened late last year. They had a burst of growth in the first part of 2023. They're now slowing again. And they've got really bad demographics. They've got actually population falling. And so what that means is that the construction sector's weak. We're seeing it in commodity prices coming down, and Chinese inflation is zero. Yeah, unlike the rest of us are fighting inflation, they've got no inflation. They're cutting interest rates in China. And for the Western world, we import goods, manufactured goods, electronics and clothing and all this other stuff from China or whatever. And if they've got low or zero inflation there, they're going to be exporting that to Australia. In fact, when we look at our most recent inflation data here, you can see things like household furniture and things like that. Prices are actually coming down. They fell only at 0.2, 0.3%. But we're starting to see the early stages of that disinflation in China, the slowing inflation in the US, impacting our economy. And that's why when our inflation number came out earlier this week, it was a good result. It was lower than market expected.
At 6%.
Correct.
So how important is it in any thesis around what's going to happen with inflation in Australia and therefore what's going to happen with the interest rates in Australia in the future? In any thesis, how important is the imported inflation in the argument? In other words, what we're importing from the US, what we import from, we don't import much from Europe or the UK, to be frank. It's mostly China and the US.
Yep.
So they're both heading in the right direction. In fact, China looks a bit scary in some respects.
A little
it looks
bit,
like
yes.
It's going to the Japanese level, which, we don't want. But from our point of view here, sitting here in this country, it's not a bad thing for us if we can import stuff cheaper over time.
Correct. If we can get those goods that are manufactured in China, a lot of the electronic goods are like the tech stuff that we get from the US and machinery and equipment, that like sort of high-tech stuff.
And also raw materials.
Indeed.
Well, we had Bill sitting here talking about the cost of timber and things like that for building and construction.
Correct.
Big deal.
It's a big deal. And even like oil price, the global oil price. See, that's something that's driven by not even the US or China as such. It's the output from the Middle East and other countries as well. So, and even though the oil price has kicked up a bit the last week or two, it's still way down on where it was 18 months ago. Remember, we got to 120 US dollars a barrel. It's now about 80. It got to 70 a bit before, so it's up $10 a barrel, but whatever. But it's still lower than it was. So all that news from the global economy filters in to what we are paying at the petrol pump, what we're paying in the supermarket, what we're paying for it. The big retailers when we buy clothing and furniture and electronic goods. And in that June quarter CPI that came out, we saw the first hints of it. Like all economists, I'd love to see the next few quarters of data. My hunch is that we're going to see very weak results on those items in the inflation basket, and that's why inflation is going to keep falling.
And of course, the previous RBA governor, Glenn Stevens, has been earmarking international inflation on every statement. So I guess what you and I are trying to do here is give context, given what's going on in the world at the moment in relation to other countries' inflation, what he means by that. He's not just going, I'm going to put interest rates up if the US inflation number is really high. It's not about that. It's about what we import from their inflation numbers, what we import from China in relation to its inflation numbers. If they are going in the right direction, which is what the RBA is looking at all the time, and I presume they're still going to look at these things, if the rest of the world is starting to reduce its inflation numbers but not look like they're going to go into recession and still stay alive, that's pretty good news for us.
It is good news. And in fact, your point is a very good one. There's this chart. I have to confess, I can't remember what it is. You can possibly Google it, dear listeners. But it just shows, it's got US, Canada, New Zealand, UK, Europe, Australia, and I think Japan. Their annual inflation rates on a chart. Red line, blue line, green line. And while they're all a little bit different, pre-pandemic, they were all bouncing around 2 or 2.5%, maybe 3%. They all shot up. And they're all coming down. So we are part of a global economy. This globalization, of airfares and things like that too, which are sort of services. So you think you could go any airline you want and they'll charge you more or less the same to go from Australia to Europe or to Asia or to the US, whatever. They're more or less the same. So, and that's an international price. It's not determined by the locals here, because there's arbitrage opportunities there. All that goes to show that we are part of the global economy. So when I see inflation in China at 0, I see inflation in the US down to 3, Canada down to 2.8. Their inflation rates, this is the annual inflation rate. When I see those it's just a matter of time before we won't go to zero like China, but like the US, Canada, Europe, we'll be tracking lower and lower when the next few quarters of data come out. We are probably 3 months behind. We're a long way away geographically from these other centres, and while our financial markets react to the US and whatever's happening in the global economy, it takes a few months for stuff to get sent here. So the retailers have got a warehouse full of stuff that they paid more for 6 months ago. They still want to sell it. But when they get that cheaper stuff in, and if the economy here is a bit weaker, they might have to have a bit more discounting. I know it's a long way away till the Christmas sales period, but if the economy's soft, I reckon we're going to see some pretty heavy discounting. And by definition, that's lower inflation.
Okay, so that's global or international affairs. Domestically, we have a couple of outliers in terms of price increases, and we're talking about gas, electricity, those sorts of things. Will the RBA park those things and say that they're one-offs?
The reason I'm hesitating is because I'm not sure. So it's like dwelling rent is the other one, insurance is the other one. So there's these things that have gone up not because interest rates were too low. Like insurance premiums have gone up because of the floods, the higher risk from bushfires and all this other stuff. They've gone up a lot. Same with dwelling rent.
But are they one-offs? Do you think they're...
I think they are one-offs.
Yep.
Yeah, sure. The insurance that we're all paying and, the electricity prices that we're paying and gas prices, they're up. But and they will feed into the inflation data. Of course they will.
The gross number, yes.
But, and this is an important but, a little bit like, there's been plenty of examples of this. Mark, you and I have spoken about these. Remember Cyclone Yazi, I think it was, blew away all the bananas in Queensland.
And we also had the lettuce problem.
And the lettuce problem a year ago,
the floods.
The lettuces went to $10 a lettuce from $2, $2.50. That did impact inflation, even though they're not the biggest items, but the fact that they went up 5 times in price, that added 0.5% to the inflation rate. Now, long-winded way to answer your question, the RBA is not going to hike interest rates because the price of lettuce went up because of a flood or bananas went up because of a cyclone. The question about energy, like electricity, insurance, is if there is a second-round effect, they get a little bit worried. If it's a one-off, they'll probably just take a deep breath and say, look at the trimmed mean, the underlying inflation rate rather than the headline figure. The second-round effect, by that I mean, is if the business sector is paying that and they say, gee, my cost of running my business has gone up, I'm going to pass it on. So the price of my cappuccinos, because I'm paying more insurance for my insurance and all this other stuff, I've got to pass it on. That's when they start to get a little bit worried. I think at this stage, a lot of those things are more localised to the household sector rather than a more broadly based. And a lot of it's happened already. If you look at, the numbers that came out, some of those insurance numbers and the like were in the inflation numbers of the last 12 months. They're already there. And I know there's another hike in energy prices coming from the 1st of July. We'll see the data soon. But I still think that the RBA will and certainly should look past those. Hiking interest rates isn't going to cause the electricity price to fall.
Yeah.
Will it? No. It might.
We can't use less electricity.
No, it's a given. Yeah. It's sort of like an essential. It's this essential versus discretionary, right? If the price of cappuccinos falls because no one's buying them because, I better save my money, got to pay my mortgage, fine, that's good, unless you're the cappuccino man. But if it's essentials, you don't want to crunch the economy because of something that's outside the interest rate control.
Right. So if we now look at, you and I talk about this all the time, if we look at we had a 6% number.
Yep.
If we go back and look at just the last 3 months, what was the last 3 months? And if you just extrapolated forward, not going up or down, we just say just still the same. What are we looking at?
June quarter, 0.8% for the quarter.
Yeah. And so less than 1%.
Less than 1%. So if a quarter is a quarter of a year, so multiply it by 4 to get an annualised figure, 3.2.
That makes a bit of sense to me.
Yes. And in fact, one of the things that annoys me, I must confess, is when you're looking at, say, the annual inflation number of 6%. In the September quarter last year, when the CPI was 1.8%, that came out in the September quarter. We got the December quarter data. It was still in the year-on-year figure, still in the year-on-year figure, and it still is in the year-on-year figure. So the RBA can't hike because of that same number. They've got to look at the turning point.
Yeah.
And that 0.8 is a really important issue. And next quarter, that 1.8 will drop out of your run rate. So just assume we get another 0.8 for argument's sake. Your annual inflation drops from 6 to 5.
Yeah.
And then we've got another 1 point something, I can't remember the exact profile now. And if we get another 0.7, 0.8, all of a sudden you're down towards 3%.
So a run rate is going to be like less than 1% per quarter.
Because you're dropping the stuff out from 6, 9 and 12 months ago.
Which was not being affected by interest rates.
Correct. And that's why they hiked.
Yeah.
It's not why they need to hike now.
Yeah. Okay. So we've got international inflation numbers, and GDP is in our favour. Imported inflation is at an all-time is at a lower point. Locally, there are some things which are non-discretionary which are going up, but it may be that they should be stripping those out. Even if they look at the data that's in front of them at the moment, on a quarterly basis, we're in good shape relative to inflation, I'm saying. In other words, interest rates are working.
Yes.
We now need to go to your board because I need to know what you think.
Look, it's a really interesting thing, Mark, and it's changed quite a bit for some of the reasons we've already discussed. But we look at the monetary policy checklist. So GDP was 0.2 in the March quarter. The partial indicators for the June quarter suggest we're going to have another soft result. We're going to have another pretty weak result. So that's neutral. So, the economy's doing okay. On GDP alone, you don't need to hike anymore. You don't need to cut yet either, so it's okay. Inflation, I'm moving for the first time since we've had our checklist here to tightening to neutral, and that's because of the 0.8% for the quarterly. And in fact, the monthly inflation numbers, because the ABS have put out an experimental monthly consumer price index, in annual terms, it's 5.4. So it's leading the quarterly numbers lower. So again, you're not quite ready to declare victory against inflation, but gee, it's looking encouraging for all the reasons we mentioned. The labour market, well, I'm going to leave that in the tightening column. 3.5% unemployment rate, which, first of all, it's good news, but there is a slight risk that wages will be a problem. At the moment, I'm going to keep them in the neutral to tightening. They're not quite yet a problem, but there's still anecdotes of labour shortages, skill shortages. I'm going to have to pay more for my staff, this sort of thing coming through from a lot of the corporate world. So that's sort of more neutral to tightening. Now, international economy, I'm going to whack that over towards neutral to easing. It's slowing down. We mentioned that already. China's weakening. The US, even though growth's still happening, it's slower than it was. Europe's in trouble. Germany's actually in a recession. So we've got the big
New Zealand's in a recession.
Yeah, so we've got the economy, enough economies, looking pretty crook. House prices, well,
it's a bit weird, isn't it?
It's a very weird thing, Mark. I'm going to put that in neutral because we had the peak to trough decline to the early part of 2023, about 9-10%. Since February, prices, according to CoreLogic, are up about 4.5%. Sydney's up about 7%. Like supply and demand, we've discussed this in earlier discussions, but that immigration inflow is huge. We're not building enough properties. We've got a shortage and people are buying them, prices are going up. And that's a pretty broadly based thing. It's across most capital cities too. So house prices, you're not going to hike because house prices are edging up, but you're not going to cut either because they're not destroying wealth and that sort of discussion. Retail sales, grim. They're easing. We consumers, we're not silly. We're confronting cost of living pressures. The mortgage servicing costs, again, they've gone up for most people on a sort of a new average mortgage. They're paying $1,000 a month, if not more, if not quite a bit more in the big cities with big mortgages per month because of interest rates going up. That's $1,000 plus that they're not spending elsewhere.
That's $12,000 a year, which is
it's a lot of money.
About $16,000 extra.
Correct. And so therefore retail sales have been trending down and down and down. And in fact, they're really weak. So the retailers are under a fair bit of pressure right now. So, and that actually, and don't forget that retail spending or consumer spending more broadly is over half of GDP. So we were talking about risk of recession or will GDP be negative or just small positive. If you've got consumers staying at home, not going out for dinner as much, cooking at home rather than eating out, that's fine. But it actually, if you're the restaurant owner, you're in trouble because no one's going there anymore because it's too expensive. Now, consumer sentiment, miserable again. We consumers, we're seeing cost of living rate hikes. That's a similar thing to the retail sales. Building approvals. Well, we had a bit of a jump last month. It was one development in New South Wales. They are still really weak. If I was to sort of think about what's going to get a property developer to build, interest rates are a big issue. In fact, we should be cutting rates to encourage more construction. I know it doesn't work quite that simply, but that's the case. Business investment, that's a decent thing. That's going well. We need it. It adds to our productivity. Again, productivity has been one of these bugbears for the economy for, 10 years now, or maybe even longer. Australians, we sort of do okay, but our productivity is not great. We need more CapEx, more business investment, business confidence. It's okay. Commodity prices, well, I said they were falling before. They've come back up a bit. I'm going to put that in neutral, because the price of oil's come up a bit. Copper, lumber, wheat, the Ukraine-Russian thing, so it doesn't get quite the headlines that it used to, but there are consequences for a lot of food, for vegetable oils and things. So there's, the wheat, really important parts of, the food production process that are impacting. Stock market's edged up. I'm going to stick that in neutral. It doesn't really have a big impact. And current rates, I'm moving to the slightly easy because the 4.1% cash rate is very tight. We've had 400 points of rate hikes in about 15 months. We don't need to cut them, but I don't think we need to hike them.
So we've only got one red dot in tightening.
Yes.
And that's the labour market.
Yes, that's still strong.
I don't think before we leave today, we must cover off something. There's this concept. It says it's pronounced Nairu, Nairu, and it relates to the labour market and wages and productivity. Can you? And we're getting a lot of talk about this, so for those people who may have come up across this term, what are the economists, and particularly the RBA, what are they talking about when they talk about Nairu?
It's a theoretical concept. Very hard to observe in real life. Like the numbers we just put on our checklist here, we can see what retail sales were. They were X billion dollars last month. We can see that unemployment is Y%. Nairu is this concept that the central banks, and especially our Reserve Bank, they have a real bee in their bonnet about it. They look at it more than the Fed or the New Zealanders.
They keep talking about it.
They talk about it all the time. And I think they might be over-egging it a little bit. But anyway, it's a concept that if you have an unemployment rate that is below Nairu, there are labour shortages, and the only way that businesses can hire, because there's not enough workers around, is to put up wages. How do I recoup my wage cost? I put up my selling prices. The wage price spiral happens that way. Turning that on its head, and this is what do we call Michelle Bullock, the RBA governor-elect or nominated, starts in September. She put out a speech roughly a month ago saying that in her estimate, or the Reserve Bank's estimate, Nairu is about 4.5%, so 1 percentage point higher than it is today. 140-odd thousand people more unemployed, according to their figuring. And why they have the bee in their bonnet about that is that they're worried, genuinely worried, that if the unemployment rate stays at 3.5% and doesn't go up towards Nairu, 4.5%, that wages will increase. That'll feed into inflation, and it makes their job harder to get that inflation rate back to the 2 to 3% target. Now, as you touched on, there's a hot debate going on in the markets. People are now openly saying, look, we've got unemployment. We've had unemployment for 3.5%, at 3.5% for a year now, more than a year. And what's happened to wages? They're only growing at 3.5%, which is fine. So what's this concern that the RBA has? Their theory is being disproven by facts.
So Nairu is the level of unemployment that, in theory, that the RBA would like to see, whereby that level of unemployment does not increase wages to such an extent that employers decide that they're going to put up the price of their goods and services.
Beautifully summarised in about 20 words. Well done, Mark.
Okay.
I love it. I love it.
So,
can we trademark that one?
But it is a theory.
It is a theory,
It's
yes.
a theoretical number.
Correct.
But so we have a new Reserve Bank governor, okay?
Yes, we will in September.
Whatever you call it, elect or whatever it is.
Nominee,
whatever the word is. But
yeah.
And she wrote about this the Tuesday before the last RBA meeting.
Yeah.
So she wrote about it on the last Tuesday of the month before the first Tuesday of the next month. So, and I remember reading it, and I looked at it. Yeah, come on, dude, don't do that to us. She's sort of suggesting to everybody that they're going to push interest rates up sufficiently to increase unemployment to the Nehru number, which is 4.5%. So in other words, they're going to go from 3.5% to 4.5% unemployment by way of interest rates.
Yeah. So when we stop spending in the retail sector, that retailer of furniture, the retailer of hotels and clubs and pubs and restaurants, they're going to hire less staff. That's how it works. Because, when you're busy, I need 10 staff. Oh, only half the number of people are coming through. I only need 5 staff. That's 5 people unemployed. And that's what the RBA is talking about.
That's a problem. Socially, I think it's a problem. Because people got mortgages.
Socially and economically, and they've got rent to pay and this whole thing. So in a sense, and again, that was the point that some people who were critiques of that speech and the RBA's 4.5% were saying, that extra 1% is about 140,000 people who currently have a job today who will not have a job, i.e. they'll be unemployed, when that 4.5%, I'll call it a soft target for the RBA, is met. 140,000. So if a third of them have a mortgage, a third are renting, and a third of them own their own home outright, there's going to be 50-odd thousand people struggling with their mortgage repayments.
And they're 50,000.
And their rent.
And they're 50,000 people by who.
And they're not going to spend money.
And they contribute to the economy. And as well as that, those people are paying rents, and they're consumers who contribute to the GDP significantly. I'm going to put it on you now, Steve. So we've gone through your board, but we know the competing interests of the new RBA governor-elect. Nehru, 4.5% unemployment. What do you think she's going to do? What do you think? Not her, but what do you think they are going to do in the next meeting?
I think they're on hold. I think, and when we sort of go through the wording of each statement, the minutes that they put out 2 weeks after each board meeting, the last few meetings, some which they've paused, some which they actually have hiked 25 points, there's always been a discussion in the last 4, I think it's been, do we hold or do we go 25? And it's been roughly 50-50 for the last 4 meetings, I think it is. This meeting is going to be the same discussion. Do we go 25 or do we hold? The reason why I think we hold or they hold is because of this inflation number that came out. Global inflation pressures that are decelerating, as we just discussed. They'll still, when they put out their statement, we've kept rates steady, but if there is a move in the next few months, it'll be up, not down. That sort of commentary might come with it. They will express some concern about maybe the labour market being too tight, so Nehru being a long way away from where we are right now. But I think they can just sit tight. The other thing, Mark, which I think we tend to overlook or can overlook, and this is more as much good luck as it is good management, the government's delivered a $20 billion surplus. Now, good luck, I mean, commodity prices were higher, and indeed the labour market was stronger. So there's Jim Chalmers, the Treasurer, sitting there raking in the money without doing terribly much, to be honest. But to his credit, and you give him a little bit of credit, he didn't recycle it into the economy. He kept the $20 billion to reduce government debt. Good. I agree with that after 15 years of deficit. But what that means from this perspective, from the economy's perspective, that's $20 billion surplus is $20 billion not in the economy adding to inflation pressures. So we've both got fiscal policy, the budget, the moderate budget surplus, interest rate policy, constraining growth, impacting us. We're hunkering down, cutting our spending, being very cautious and being a bit nervous, consumer sentiment being bad. And that will feed into lower inflation as businesses realise they can't keep putting up their selling prices.
So just to finish off, so in a pure money supply or M2, look at what's driving inflation or what's driving inflation down, all the right signs are there in terms of money supply.
Indeed. Yes.
All the right signs. By the way, the opposite of what actually created inflation in the first place. Because when inflation was there, it was around the other way.
Just in 20 seconds or less, remember why we got from 2% to 8% inflation at the end of last year. The government, again, it was COVID, so I'm not being critical at all because we didn't know what on earth that COVID meant for society and for the economy. They printed money, hundreds of billions of dollars. They cut rates to zero. This is globally, not just in Australia, but around the world. In fact, the US, I think they spent a couple of $1 trillion. Like, that's a lot of money. I don't even know how many zeros that is. But there was all that money, liquidity, M2. It was flooding around the economy. And for a moment there when we were stuck at home, we couldn't spend it. It didn't show up in the data. But as soon as we got vaccinated, as soon as we got let out of the house, bang, off we went. And then businesses thought, gee, I'm going to put up my selling prices. Supply chain problems meant that we couldn't get these things. So for those lucky people who had an inventory of cars or whatever, they jacked up their prices. And that's where the inflation rate came from. We're I'd say we're halfway through, maybe a little bit more than halfway through that transition of money being sucked out of the economy. And by the end of this year, certainly by this time next year, we'll probably have these inflation rates around the world sort of close to the targets that the central banks want them. We won't get there overnight, but we're getting there. And the momentum in the last, 6 months has been in the right direction.
I'll put you on the spot. Did Dr. Lowe do the right thing? Theoretically, in theory, because look, I'm not talking about what he did during COVID. I'm talking about
this subsequent.
As soon as inflation started to show its ugly head, has he done the right job?
Do you know what? He might be looked at better in 12 to 18 months' time than he was the last 12 months.
Definitely more favourably, I think.
Because if by this time next year inflation's at 2.5%, unemployment's only at 4%, so maybe a little bit below that 4.5%. The economy muddled through this second half of the year.
No recession.
No recession. It'll be weak, but no recession. And that, Michelle Bullock as governor can then start cutting rates because inflation's back under control and around the world inflation's falling. So we'll look back at Dr. Lowe's time thinking, maybe, mate, you did the right thing. Maybe you actually did okay. And even at the time, we're all screaming and shouting, saying, you're doing too much, too late in the cycle. We've got to remember that verbal error, if we can call it that, no hikes till 2024, which he's still being chastised about. Look, that was a mistake. Who hasn't made a mistake? Put up your hands if you haven't. I've made plenty. That was a mistake. He acknowledged that. But in hindsight, he learned from it. That's the other thing that he's done. And alas, we'll see. But I reckon when we do this early in the new year, we might be saying, gee, Dr. Lowe did a pretty good job in the end, didn't he? I'll have to eat a little bit of humble pie if that's the case.
Me too.
Yeah.
But we'll soon see. Thanks, mate. Good to talk to you.
Thanks, Mark. Terrific.